Hey everybody, Signet here with the Bullish Bears. Today we're going to do a little video on ETFs that I watch and maybe a little bit about sector rotation with those ETFs if we got the time for it. So the problem with a lot of ETFs is that they're not liquid, they have a very low ATR, or they gap more in the overnight hours than they do in the daytime. That's most of the complaints that I deal with when it comes to dealing with ETF products. There are quite a few that represent the same market. They're just a different product. So like BlackRock, Spiders, Vanguard. Those are three of the big names that come to mind. iShares is another one. So let's look at a couple of these. SPY representation of the S&P 500. It's an experimental product, has 3 expirations in a week. So does the SPX. These two products are completely different than any other products on the marketplace. They have the most accurate expected move out of any other product. The reason for that is vast, way beyond the time that we have in this video, but the way that you could look at trading either one of these is the SPY is like 1/10 the size of the SPX. So when you're looking at a smaller account, maybe you would want to avoid the SPX, or if you're looking to try to trade a new kind of strategy that you're developing, you would want to dial that back, maybe apply it to the SPY instead of the SPX. They're both very, very liquid. The daily average in the SPX is around 1 million contracts, and in the SPY around 3 million to 4 million contracts. They make up 60% of the volume in options in the marketplace. It's absolutely liquid and very powerful market. So even if you're not wanting to trade the market, keeping your eye on the SPX would do you good. When you see the S&P 500 moving, you could expect anything that you're trading to move accordingly, all right? Because the S&P drives order flow in the marketplace. So the ES, the SPX, the SPY. The first ones on the list are all indexes. The Russell is another one, and it has 2 different ones that I like to trade. You got the smaller version, the IWM, and the larger version, the RUT. Both of these, again, are almost identical products, 1/10 the size of the other one. So if you're very sure and very secure in the trade that you're going to take, if your trade strategy is really advanced, maybe you would focus more on the Russell and less on the IWM. The DIA and the DJX. Notice that these two are almost identical. All right. One is the Spider DIA and the other one is not. It's the Dow Jones Industrial Average DJX. Either one of these are liquid. They're both fine to trade. You don't have to watch them both. You could watch one or the other. You can see that one of these is a 24-hour-a-day product, not for options, but as a traded product. You have the Qs, and that represents the NASDAQ, and then you have the NASDAQ 100, or the Index. Notice again how very large the Index is versus the Qs. The Index 100 is one that I like to watch because when I go into Market Watch, if I go to Visualize Index, I can choose to look at the NASDAQ 100. And now I have a representation of everything that this is moving based on. Right? And that's how I like to do that. You can do that with the S&P 100. There is an S&P 100, but it's not as liquid, so I don't watch it as often. And then we've got the VIX. Now, there are a lot of VIX products out there, and I avoid all of them. The only one that I mess with is the VIX, and there's a very good reason for that. One, I know exactly how this is calculated. This is calculated based on the bid-ask spread of the SPX 30 days out. So I know exactly how this is calculated. I know where 0 is, and 0 is the lowest ever recorded settlement option price, which is $9.10. I know its lowest value, which was $8.56. So when I'm looking to get into a VIX trade, I look at this product. I know when it settles, it's got a European settlement, which means Tuesday is the last day that you have to play with the options. And on Wednesday morning, it gets its settlement price from the SPX. You wrong word. You won't typically be assigned in these. If somebody wants to put it to you, they can't do it until the day of expiration. That is why I like to trade this product. This is the VIX that you want to focus on. Market brokers will give you a better, what do they call it, assigned risk when you want to trade this. Your margin requirements are going to be less if you trade this VIX versus other VIX. If you get into double and triple leveraged VIX products, short-term equity, ETF, all these different kind of VIX out there, you don't know what it's calculating. You don't know where the calculations come from. If you do a lot of homework and you figure all of that out, and then you want to trade it, sure, why not? But you want to be very careful about what VIX products you focus on or try to trade. The TVIX is a really great example of a manipulated VIX product. The Credit Suisse actually has market participants who are authorized to buy it or sell it in bulk to manipulate the price of that VIX ETF product. Right? Who would trade that? Who would voluntarily offer to participate in a market that has authorized manipulation? Right? Not me. I want to avoid that. So when it comes to VIX products, this is the one. I don't even look at a lot of the other ones unless it's a futures product. United States oil. Let's talk about these a little bit. So there are a few products that I like to look outside of futures. All right. Normally, if I look at products, I look at futures, but there are ETFs: oil, silver, gold, and bonds. All right, you got the 7 to 10 year bonds, and then you've got the 20-year bonds. I absolutely watch these. I trade these. I appreciate these. I recognize their impact in the marketplace, and they are the ones that I keep track of. Outside of products, we've got more of what I would term risk-on markets or speculation markets. So here we've got emerging markets. Sounds exactly like what it is. You can see how sporadic this is. This thing gaps a lot. Overnight moves, pre-market moves. Your best plays in this is to go for a longer term trade, right? Kind of identifying overall price structure and taking it in that kind of trade pattern. XHB, home builders. Again, when you're in a strong economy, this is where I like to focus. FXI. This is China's market. China can be manipulated by its government, but that offers trading opportunities, right? When we can recognize that the Chinese government is going to put money back into their markets. And this is an opportunity. Now, it's interesting that I bring this up because we do want to look at different countries. When you hear on the news that there are events going on, say over in Turkey or Europe or Mexico, Japan, you can take the opportunity to trade on those ETFs. I remember last year in 2018, the Turkish lira had negative news in the United States media, and we traded against that ETF product for 3 days as it just got hammered to the downside. You want to take advantage of those. So China is one. We'll jump off of those for a moment to talk about the NASDAQ Biotech. It's another risk on. Right? It is biotech, which it's more speculation, but it's also a NASDAQ product. Now back to countries. We got Brazil, always one that I'm interested in keeping an eye on, find trade opportunities. Mexico, Japan, and Russia. And by all means, these are not the only ones out there. You can see I was keeping track of a price range here, had a really great breakout, nice trade opportunity. But these aren't the only countries that we could focus on. They're just the ones that typically are in the news, and so they're typically the ones that I hunt for. Use this for a representation and for an idea. If you're hearing about a country in the news a lot, maybe good news, maybe bad news, right? Massive earthquake, whatever it is, we don't want to hope for bad things to happen, but that doesn't mean that we can't capitalize on, maybe a rebuilding market or some other type of situation. And then we've got um, sectors. There's 9 sectors that I like to watch. The top 3 are offensive, the middle 3 are midline, and then the bottom 3 are defensive sectors of the marketplace. They're all XL products. I built them into a 3 by 3 by 3 grid. I watch them throughout the day. Keeping track of sectors allows me to identify weakness in different industries, right? Maybe XLF, the banking or the financials, maybe they're up today, and I'll go look at something like American Express, and then I'll take advantage of American Express rather than trading the XLF, because the XLF doesn't move very much. It's got a very low ATR, and yet American Express moves way better than that. So we've got financials, technology, consumer discretionary. This would be the more frivolous side of spending. This would be Wynn Resorts, maybe Carnival Cruise, XLI, industrials, and I'll flesh that out here in a moment. Then we've got materials, energy, consumer staples, which would be the other side of spending, more of the durable goods, household products, things that you're going to buy no matter what the economy looks like, right? Toilet paper, soup. You're going to go to the store. You're going to go to, your local grocery, so Walmart, places like that. Healthcare and utilities. Those 9 sectors really represent a very strong, broad part of the marketplace, and we can break those sectors down and watch for what market sentiment is, right? When it comes to risk on markets, if we're in a overly cautious market environment, or if we're in a bear market, people won't speculate on products. They'll put their money in defensive products, right? They'll dial it back. So we do need to talk a little bit about this. One of these was XLB, materials. And that's very misleading. It's like, what's materials, right? Materials are chemicals, metals, mining, paper, forest products, containers, packaging, construction materials. So that's really the representation from XLB. And another one was XLI, right? Industrials. Well, that's kind of misleading too, right? What the heck is industrials? Aerospace, defense, transportation, air freight, logistics, machinery, road and rail, commercial services, commercial supplies, right? Industrial conglomerates, that's a word for you, right? But that's a representation of those 9 sectors. And then we can look at things like KRE, right? And this is, again, one of those markets that I really keep an eye on. IYT, it's another transportation, and SMH, right? So this is a small representation of the products that I like to watch, but I find a lot of value in these, right? So XRT was retail products, KRE is banks, IYT transportation, semiconductors, SMH, right? This is speculation market, right? Semiconductors, but it's also another way to participate in the market. Say AMD, things of that nature, right? Chip stocks, things like that. Semiconductors, they've got their own niche as well. And we want to take advantage of those kind of markets. Like semiconductors, it's very speculative. It's innovation. It's advanced places where people would put their money. Strongest trends in technology, that kind of stuff, right? It's not going to be a defensive market, but putting all of those together offers you a wide range of trade opportunities, and these are literally the the markets that I watch and find trade opportunities in. Some of them represent some really good intraday trade opportunities. One that I'll point out very specifically is the XLF. The XLF oftentimes has a really great gamma load in the front week. And if you have ever participated in a intraday trade gamma scalping, you can see that you got $1.59 gamma and 62-cent delta combined. You could grab a hold of this 15-cent option, and with one strike price shift increment, you could sell it back to the marketplace for 62 cents. This is a massive move. All you need is 50 cents to get that move. And you get that kind of market move because of this gamma load. Right? And that's exactly the kind of thing that we want to look at. You could trade the same opportunity to the downside, whichever presents itself. But I really enjoy taking advantage of gamma scalps or gamma trades on an intraday basis when I see it setting up for that type of environment. So don't look at these only as things that have to be built into a spread or things that you can only swing. A lot of these products on an intraday basis really do offer opportunities to trade. So, a wide swath of products, markets, opportunities to be traded. And you can also use them to gauge overall market sentiment. So not just things that we might trade, but things that we can look at to find trade opportunities in other industries that are connected to this sector. I appreciate you watching this video. I'm going to attach this watch list into the link, and I look forward to seeing you at the next one.